Hi, I'm Karen Webster, and welcome to today's digital discussion on international payments. I'm joined today by John Hammond, Chief Commercial Officer, and Todd Latham, VP of Marketing at the Currencycloud. Currencycloud is a venture-backed company that's been around since 2002 and squarely focused on the global international payments landscape. John, Todd, welcome. Thanks for joining me today.
Thanks for having us, Karen.
Good afternoon.
So before we jump into our conversation, I thought I'd put the topic in a bit of context. So global payments is a space that's increasingly crowded and even a little bit noisy. In fact, next to Apple Pay, it's the topic of conversation all over payments. And for very obvious reasons. One in particular, commerce is global, and where there's global commerce, there's the need for global payments. $26 trillion worth of a need, to be exact. That's in fact the size of the market for global payments overall by some measures, but also where there are many specific areas of dire need, such as the small to mid-sized enterprise, which accounts for about 20% of that total, but very underserved and off the charts in terms of needing better solutions. So it's not surprising that many existing and emerging providers have chosen to target this piece of the payments pie. There are platforms and gateways and third-party innovators that have all taken a different tact as they vie for their slice. And all the while, incumbents are trying to figure out how to innovate but not cannibalize their important revenue streams. So for Currencycloud, the focus is about modernizing a system of moving money between businesses and banks around the world that's been pretty much static for 40-plus years, yet drives about 85% of the volume today. Currencycloud is an alternative to banks that serve those players, whether they be individuals or businesses, who simply want to move money to others cross-border, safely and in compliance with the myriad of regulations that exist and differ everywhere in the world. But today's discussion isn't focused entirely on Currencycloud and what they do. We'll certainly talk about that a bit, but really the state of global payments, the landscape, what's broken, why there's a need for a better solution, the role of regulation, where virtual currencies fit or not, and some innovative ideas for actually fixing what's broken. So John and Todd, with that as a backdrop, let me turn it over to you. Todd, do you want to get us started and tell us how we're going to organize our chat today?
That's great. Thanks, Karen. So first of all, thank you everyone for your time today. Hopefully it will be interesting and informative, and please do ask questions through the presentation if you have any, and Karen will read those out. So the way we're going to structure the conversation is I'm going to give you a very brief overview of the international payments landscape, and it's a really interesting area. So I'm going to just delve into some of the facts and figures and how that landscape breaks out. Then I'm going to hand over to John, who's going to talk about the API revolution and what APIs are doing to transform the way that the technology is influencing finance today more broadly, but also in this space. Then I'm going to take you through a very brief tour of what regulation means for a fintech company and how we think about it and some of the opportunities in regulation. And then we're going to end up on everyone's favorite topic, virtual currencies. We thought we'd put that at the end of the presentation just because we know there's going to have a lot of conversation on it, so we wanted to make sure that we had a chance to cover it off properly.
That sounds great. We saved the spicy stuff to the end.
Exactly that, the best to last.
So why don't we dive in? Give us the scoop on the broad landscape for global payments.
So I think you summed it up, Karen, when you said that the international payments market is huge. So $26 trillion. It's one of those numbers that you can't quite fathom. Let me put it into context. It is 1/3 of global GDP. So a third of the GDP of every country in the world is paid internationally for imports, exports, remittance. And we did some work this year to try and break this up. And there's no definitive source on this. We've had to take this data from a lot of sources. So I'd be interested to know if anyone's got some better numbers. But this is our rough sizing of the marketplace. What's really interesting is the bit that we all know and love and the bit that we talk about is tiny. So that peer-to-peer piece, the bit that we spend as consumers is $500 billion according to the World Bank. So it's a very small slice of the overall pie. Then at the other end of the spectrum, you've got the corporate business. So corporate commodities, huge giant payments, everything from oil to treasury payments within big multinationals. And that's the lion's share of the overall market. And then in the middle, you've got a pretty meaningful bucket of SME trade. So let me just take you through what those mean and how we think about the market. So if you look at the top end of the market, the corporate commodity stuff, the reality is these guys, they don't need technology. They're all experienced brokers, they're traders. They really understand the space, and what they value from FX and international payments is service, expertise, and value. So they're dealing directly with the huge banks. They're getting a great deal. They can talk the same language. They're very sophisticated. At the other end of the spectrum, you've got peer-to-peer firms, and there's been an explosion of innovation recently. So this has been dominated over the years by people like Western Union and MoneyGram. And what you're seeing is new companies like Zoom or TransferWise coming into this space, and they're just bringing a much better, much crisper user experience. It's all digital today, and they're really bringing down the pricing to the point where at some point this business is going to be relatively close to being free. They're really, really squeezing margins, and they're playing on price. That's really what they're playing on. Where we think there's this huge forgotten segment is SMEs. And I'll just give you a story. When I joined Currencycloud, I was talking to an American businesswoman, and she's a consultancy in the US, and she sells in the US and in the UK. And the first thing she said to me was, "Can you guys sort out how I can transfer money from one place to another? Because my bank just sucks at it." And I think it just really sums up the frustration that these businesses have when they're trying to trade internationally. It's hard, it's complicated, and it's opaque.
So Todd, before we move on and find out why this woman says it sucks and what's broken about it, there's a question already. 26 trillion, you got people's attention. Is that on an annual basis?
Yeah, so it's a total throughput number, and that's on an annual basis. And this number came from McKinsey. So they did some research earlier on this year, which came up with that 26 trillion number, and it's pretty similar to a number that BCG pulled together for a similar study.
Great. Okay, let's move on to talk about why the small to medium enterprise is not only forgotten but broken. Give us the scoop on that. So
essentially it comes down to three things. One is international payments are really slow. If you want to send money from the UK to Australia, it takes 2 days. The only way that you can actually do it any shorter is to pre-fund or to work with a company who's pre-funding. So again, if you're a larger organization, you can go do that. If you're paying a one-off invoice, if you're a small company, you haven't got the sophistication or the capital to be pre-funding your payments out to a different country. So it's really slow. Secondly, it's really expensive, so typical costs can be huge. For consumers, they can be up to 15%. And I'll give you a personal example. I went to the airport recently. I took out some euros from the ATM, and the ATM had these huge signs over it saying 0% commission. When I went back and I checked my statements when I got back from that trip, it had cost me 12%. So the 0% commission, I think most people know is an anathema. I don't think people really understand just how much they're paying. And even for businesses, you're going through a broker, you're paying typically 1 to 2%. And if you're less savvy, up to 3 or 4%. So, you're typically spending a lot of money to transfer money overseas. Now, just picture this. Imagine you're a bicycle manufacturer and you're importing parts from China. You're working on margins that are, say, 5–10%. It's a low margin business, and your manufacturing costs are a great big chunk of that. You're paying 4 or 5% on your manufacturing costs. That's coming straight off your bottom line. So this is a meaningful amount of money for small businesses.
So Todd, question about that. Why is it so broken still? Aren't there a lot of firms doing a lot of different things to try to solve for these problems?
Yeah, so that's a really good question. I think there are two things. And actually it all relates to this third point here, which is the opacity. It's really unclear how much you're spending when you're making a payment. So unless you've got the savviness and the time to go and understand what rate you're getting and how that compares to the mid-market rate, you're not going to be really clued into what you're spending. But there's another thing that happens as well, which is when you're paying through the SWIFT network, which is the network of choice for most international payments today, you have these fees called correspondent banking fees. And I've got a real life example of a customer who was in France and they needed to pay a bill in Ecuador, and they sent $1,000 roughly equivalent. When their money arrived the other end, they had gone to 3 different banks, and each bank had taken $30 off that transaction. So when they went to pay their bill, $910 turned up. They then had to make another transfer for $90 plus the $90 they knew they were going to incur this time, so they had to pay an extra $180 on that transaction. And so the reason it's not been fixed is down to two things. One is it's really easy to hide charges in international payments, and people aren't necessarily wise to it. I think people who do it a lot, they get wise to it and they find new ways of doing it. But the reality is most people just walk into their bank or phone up their bank, and that's how they make their payments today.
So is there a fundamental reason for that? Is there kind of is it because the fundamental denominator of payment is the same regardless of how the different layers that sit over top of that payment might be different? Help us deconstruct the landscape.
So do you know, I think it actually comes much more down to buyer behavior. There's a brilliant statistic, which is you're more likely to get divorced than you are to change your bank account. And that just shows how entrenched banks are. You know, I think everyone knows that one, but it's how entrenched banks are in people's lives. And so when you're dealing with a range of financial services, your default is still to go to your bank. And people talk about not trusting their banks. The reality is when it comes to making payments, people do trust their banks. They trust their banks to make sure their money is safe and it comes out the other side. And so banks have this position where they're able to charge these fees, and they can blame it on the system. This is just the way it works, madam. And that gives them an ability to do that. And, you know, FinTech, much as we like to say, it's changing the landscape and it's doing some great things. It's still relatively small. You know, we believe about 85% of payments still go through banks today.
So who's out there doing what, and how do you fit in between the various capabilities of moving payment and the instruments that may exist that people may want to use?
Well, it's funny you should say that, because we've got a slide that talks to that exact point.
How convenient.
Amazing. So there's a whole range of different companies out there, and I think this is what makes it really interesting. When you look at the landscape, you realize that everyone's got different needs. So the business who's paying, you know, a big one-off treasury payment at the end of every month to settle their payroll in a different country is very different to somebody who's an e-commerce platform who's making payments on a day-to-day basis. It's very different from, let's say, prepaid cards here. Prepaid cards in Europe are very different to the US. It's not an underbanked or a subprime sector. It's actually a very prime set of people who take out prepaid cards with foreign currency on it to spend it when they're abroad. You've got a wide range of different types of firms all providing payment services to their customers. And what makes them different is they've all got very different front ends, they've all got very different processes, and therefore very different needs on the back end. But ultimately what they do is one very simple thing. They convert funds to a different currency and they send them abroad. And this is really where companies like Currencycloud come in. So we take a wide range of different banking products. So FX hedging, so we can do real-time pricing, the ability to actually buy cash in a different currency, local payment networks, and also integration into the SWIFT network, which still remains the biggest and most prolific network in international payments. And provide that to these different companies via an API. And so our technology gives them a layer so they can manage all of these services in one seamless end-to-end experience. So they're all very different, but what they need from us is one very, very similar and simple service.
Gotcha. So two questions before we move on to the next section, which is the API bit. The 85% of payments going through banks today, that's, just wanted to confirm that that statistic is in fact a valid statistic. And then the second question is this trend on SMEs that really need solutions. Are you seeing the need in any particular geography being more acute than the other, or is this most small to medium enterprises, wherever they happen to be, find that this process or the existing process doesn't work for them?
Yeah, so first, on the first question around the 85% of payments going through banks, so is it brilliant statistic? It's, you know, you could probably pick holes in it. What we actually did was we took the overall banking industry and we tried to size up the firms outside of banks who are doing international payments, so including people like Western Union and MoneyGram, but also the fintech space and a number of other non-traditional providers. Is it a perfect stat? No, but it's rough order of magnitude.
Gotcha.
In terms of, so can you repeat the second question, Karen?
Yes, sure. The areas of need with respect to the small to medium enterprises. So geographically situated, is it evenly distributed? Some areas worse than others? What are you finding?
Yeah, so what we find is actually it's more acute in North America than it is in Europe, and that's because and also places like Australia are relatively they're more savvy about the cost of international payments, and that's simply because by nature of the size of the countries, they're more likely to be trading with their neighbours. So you know, obviously the US economy is global. You know, people can work internally inside the US economy without ever having to go overseas. If you're in Europe, the chances are that you're dealing with other countries outside of the Eurozone. You know, if you think of a country like Australia, they effectively import everything that they buy. So you know, they're very, very familiar with international trade. Gotcha.
So John, I think we're going to turn it over to you now to talk a little bit about APIs, because I know that that is really one of the things that Currencycloud is really passionate about. It's how you built your platform. So give us the skinny on APIs and their relevance to global payments.
Okay, so I think let's start a little bit by talking about some backdrop associated to APIs, and what we can see is a whole host of different types of companies, whether they're fintech or otherwise, that have built their business on APIs. APIs have come an extremely long way. When I was first in the IT industry, more years ago than I care to recall, an API was something that a software company out of their benevolence allowed you to use so that you could connect to their magnificent piece of software, and it was very functional. You can put information in here. Well, the world's fundamentally different today. There is a huge amount of competitive pressure in the marketplace and a large amount of dynamism that means that companies have to move extremely quickly. And what the API has become, it's become a way of delivering that entire service, whatever is required to do that, to the consumer. It's now about composing services and about delivering them to whoever needs that service. So you as the corporation that requires that API are pulling information in rather than allowing people to attach to your piece of software. So there's been a change in the juxtaposition of that API economy. And what's really interesting here is, if you like, we talked about service-oriented architecture many years ago, and that continues to be a key part of the world. But this, I think, is another evolution of that. It certainly has the same DNA without being the same thing. The key here is that people want to use blocks to build their solutions. And if you like, Lego bricks are no longer just red anymore in 4 pieces. They come in, roof shapes, and they have windows and doors and so on. So now what we're starting to see is much more functionality being delivered in that brick, so that companies can now aggregate together a series of APIs and deliver that to their end user as a fully complete end-to-end solution. And what happens here is that the developer is now becoming much, much more part of this process. So I hope that gives a bit of a backdrop into how that all kind of comes together. But let's talk a little bit about why it's such an important part of this marketplace. So Gartner predicts that 75% of Fortune 500 companies will have an open API. That's in the next 5 years. That's an incredible statistic. That starts to make you realize that this is a movement that's over and above some interesting technology. Well, why is that the case? Let's look at the example I'm going to use is outside of our industry, and we'll talk a little bit about our industry in a minute. So Salesforce is one of the great success stories of the cloud era, and it's about $2.3 billion of turnover associated to that business. Half of that is delivered via its API. And what's that doing? What it's doing is it's taking a whole suite of ecosystem partners and aggregating them together through that API. What this means is what Salesforce is worth to me as an individual that consumes that API is not just the fact that I can track deals, it's also all the other things that I can tag onto that. Because everyone's created this ecosystem in and around Salesforce, I've now got the ability to fill in all the blocks inside of my Lego bricks and build the wall that I want or build the shape that I want and deliver that service. So suddenly, I'm now able to access a whole host of different services so I can give value back to my customer. And I don't have to go and build each and every individual thing that I want to take out to market. Actually, all I can do is to say, I need to be able to do this business process, and I could go and acquire the ability to do that and consume that, deliver it, and compose it through an API. So it gives me dynamism, it gives me speed to market, and it gives me completeness of solution.
No, it certainly is a way of moving innovation more rapidly, because developers, innovators, however you want to describe them, don't have to do the basic blocking and tackling. They're solving for different problems, and they're embedding, in this case, that particular API into, capability into their solution. How are you seeing this play out in FinTech? There are bunches of examples, but specifically with respect to global payments.
So that's a great question. There's a whole host of various processes that have to happen when you do anything in the kind of financial technology world. So the first thing to say is banks are very much our partners, and we integrate with them in all types of different ways. So we do two things in this space, and FinTech companies do two things in this space. The first is they create a layer between the banking systems API, and we've written to a few APIs in the banking world. It's a non-trivial activity is the way I would put it. I would not consider them to be consumptive APIs. So the first thing we do is we do all that heavy lifting for the consumers. And what we do is we simplify that. So there's a whole host of things that happen behind the scenes that we can aggregate together, and Todd eloquently put us through all the various things that we need to do. And the reason this becomes powerful is each individual component is so complex that to go and build that and then integrate in traditional infrastructures becomes extremely time-consuming for consumers, and I mean businesses typically, not just not individuals as consumers. And what that means is everything is being slowed down. What the API allows us to do is move really, really fast and put together this complexity. So I'll give you an example. If I could go to a major bank and I could get very aggressive, because I could be a particular size of business, even an SME, I could really negotiate, I could get a really aggressive FX feed. I could get pretty good pricing. I'd need several $100 million worth of business, but I could go and I could secure that. But basically what that allows me to do is have FX pricing. What I then have to do is I have to then manage all of those various bits associated to that, track that payment, all the things that Todd talks about, and then I have to pay it out. All those things are highly complex. Now I can consume it. The really key thing in the FinTech world is each individual FinTech company, the reason they exist is because they're specialists in this marketplace. And what that allows them to do is focus specifically on the types of customer or the business transaction associated to that customer. What that means is we are specialists and we can deliver that service specifically to that customer set. So we are tuning our APIs to deliver that service. What that allows the consumer to do is to say, here's a payments API, here's an API that does something else, and aggregate all those things together and have specialist capabilities brought to them at pace. And you talked a little bit about things happening fast. The way we like to talk about that is internet speed. Everything's happening at internet speeds. And when you're operating at that level, the interface associated with your customer set, if I'm a specialist firm delivering services to consumers, that interface is incredibly important to me, because that is what differentiates me from everybody else. Because moving money or whatever we're doing in the fintech space, we've already established that banks already deliver that service. So I'm personalizing a service. And to disrupt that service is the biggest no-no for those companies. What an API allows you to do, or a series of APIs allow you to do, is to continue with that interface and plug in the functionality behind it.
Well, it also allows a lot of new companies to emerge that can incorporate those capabilities into platforms that they're building to solve other problems. Isn't that also correct?
Absolutely the case. And one of the things that we talk about is that we believe that cloud and the API economy are liberating businesses globally, because businesses can now compete on an even footing with people that have greater capital capabilities and greater resources to build these infrastructures. And because now the fintech community can now deliver these services via an API, every company can compete on a much more equal footing. Then it becomes much more about the quality of your business proposal to the consumer. And that's a fascinating and exciting marketplace to be in.
So where are you seeing this in fintech with respect to the piece of the business that you guys are concerned with, global payments, moving money for small and medium enterprise?
So if you look at the slide now, there's a whole host of companies that are starting to emerge that are pioneers in this marketplace that are doing really interesting things, whether that's people connecting consumers to investment opportunities, whether it's people moving money on behalf of others, whether it's people building an infrastructure that allows other people to participate in an online e-commerce world. So that the beauty of this space is that innovation is happening in nooks and crannies that people almost felt were not big enough marketplaces, but as soon as people germinate a seed in that space, we're seeing huge companies grow. And you look at companies like Stripe. That's a technology company that provides a really fascinating service, but it's doing that via an API. It's very tech-savvy, very developer-friendly, which means that individual merchants can suddenly start accessing the abilities of larger companies because they can use this technology to move at pace, and they can participate in the economy today. So, I'd love to be able to tell you where all the different fintech spaces are. If I was, I'd probably be a consultant selling that information. But reality is, the great thing about fintech is that there's a gap has emerged in this marketplace, and partly from some of the things that Todd described, partly because of the crisis of a few years ago, where people are saying, actually, let's look at alternatives, let's move faster, let's try the new technology, let's think of different ways that we can achieve our goals. And because fintech is able to present that entire business process, people are adopting that, and we're seeing that move into lots of interesting spaces.
So I know, just kind of wrapping up this piece of the discussion, you talked a little bit about how the Currencycloud API enables not just the one sliver of FX capability, but really a portfolio of payments capabilities. Maybe touch on that quickly. I'm conscious of our time, and because I want to get through the next two sections, regulation and virtual currencies.
So to make an international payment, you have to obviously buy a currency, you have to be able to move that currency, and you have to be able to track in and out and all the various funds, because nothing's working perfectly. I'm not giving you $100 and please turn that into euros and send it to someone else. I'm sending you a whole host of payments, and what we have to do is move that money around. And what this API allows you to do is to have all of those elements in it. And the way we typically describe it is to say, via this API, you have access to a global banking network, you have access to wholesale FX live pricing, you have access to liquidity, and you have the ability to orchestrate, track, and reconcile that payment. That's a lot of stuff to be able to do on your own. That's a huge amount of resource, investment, and ability to build, and also to maintain all of those relationships on an ongoing basis. And what we're able to do is allow people to consume that through the API and maintain their customer experience.
So, John, a quick question before we move on, and this is a question that I think may have a bunch of dimensions to it, so we may have to do a quick answer and then maybe do a sidebar later. So there's a thought about ISO standards that have been put into the marketplace and designed to create not an API capability, but designed to enable capabilities in a consistent, standardized way. The question is, what are your thoughts on that versus API? Is it apples to apples or is it apples to asparagus?
Great. That's a great analogy. I think it's a little bit apples to asparagus. What is really important in the API world, and if you look at someone like Amazon Web Services, they have an API. And that is not an open API, but it's ubiquitous, right? It is effectively the standard by which everyone uses infrastructure as a service. There are other ways to look at this world, whether that's a standardized way of building business process, which is typically where the ISO world is going, or whether that's writing to an open set of standards so that it's easy to connect. The key is here, what we're trying to move to, as this marketplace matures, as FinTech matures, you will see some commonality of the way that we organize this information and this interface so that it's much, much easier for people to participate in this world. And we've seen this over and over again in our industry. It was, and I'm going to sound really dull and old now, it's as simple as ISA versus MCA bus technology in PCs between IBM and Intel, and Compaq. Remember those guys?
No, I'm much too young for that.
Yeah, okay. You remember the Hewlett Packard, right? So that created the PCI bus technology, right? Which was, we took the best from both worlds and we created something that was ubiquitous. The same thing is going to happen in this marketplace. The same thing has happened with all the Linux environments. So this is the marketplace going through all the right iterations. It's all the right dynamics that appear in this marketplace. So look, we could go the asparagus route or we can go the apple route, but the reality is there has to be commonality, otherwise the consumer is not getting what they want. They're not getting it to be simple, fast, and dynamic.
Gotcha. All right, let's move into regulation, which, I mean, that is a very, very interesting topic because obviously you can't do any of this stuff unless you understand the regulatory environment and are compliant. Let's get into, and I think, Todd, I'm back to you on this, let's get into how you think about regulation and incorporate compliance into the capability that you put forward. So dive in.
Yeah, so, and I'm going to carry on the theme that John's just had. We're a technology company first and a financial company second. That doesn't mean to say that we don't spend every second of every day thinking about compliance. And I say that in jest. I swear, I never joined this, I never took this role thinking it would be so compliance heavy. And anybody in payments who thinks it's not about compliance is kidding themselves. Okay. But let me just kind of start off with I think a more theoretical point, which is, I come to work every day thinking I'm doing good. When I think about what Currencycloud is doing, we're helping these guys here in this picture do trade around the world. I'm a free market thinker, and the free movement of capital around the world is good things. It grows our economies, it makes us all wealthier, it alleviates poverty, all these good things that I think most of us know and believe. And we're helping these guys. We're helping the family who's trying to send money back to Poland or to Mexico or to Brazil or the Philippines. We're helping a wide range of people do good things. But as part of my job, I speak to banks almost every day. Part of my role is to bring on new banking partners, and the first thing that they think we're doing is trying to bring these guys on, the bad guys. I hope you like the graphic here. I wasn't allowed to show pictures. I wasn't allowed to show pictures of real people toting guns, but but that's the reality. Is you go into a meeting, and the first question that I get asked every single time is, "How do you guys do compliance?" And it's really interesting because the whole mood of the conversation is from a standpoint of, we're not quite sure we want to do business with you guys. You're FinTech, you're a startup. Just to correct what you said earlier, Karen, just as clarification, we were founded in 2012, not 2002, so we're 2.5 years old. And so it makes a really interesting conversation. So you kind of start to think, well, why? And the reason is this, and we call it asymmetric risk. If you look at the fines that are levied on the banks, the interesting thing is, for, a payment department within a bank is a department. It's one of a multitude of functions that a bank does. And actually, transaction banking doesn't make tons and tons of money. But the fines assume the entire bank's revenue. When regulators actually calculate their fines, they look at the size of the bank in totality to calculate these things. So you end up with people like BNP Paribas being fined $9 billion. I mean, it comes back to the 26 trillion. I mean, it's a number that you just can't imagine. I mean, you think about that $9 billion in the context of the revenue they make, it's just not worth it.
I mean, I don't think there's any argument with that. But what's the solution? I mean, you obviously have to comply, even though you are a company that has different capabilities and comes into the space with a different focus. So how do you support compliance? How do those who care about compliance support you and FinTech more specifically?
Yeah, it's a good question. So there are two things. First of all is, how do we think about compliance? And it's just an emphasis thing. We don't have to comply. We want to be a good business. Ultimately, we're all people who go home to our families, and we want to go home, be able to look our children in the eye and think we're doing good stuff. There's a reality to that. So we go in with a disposition of, we're going to be conservative, we're going to have robust controls in place, but that shouldn't stop the technology innovating and moving forward, and that's the key thing for us. So, we make huge investments. We make investments in know your customer capabilities. We collect, more data than frankly we'd like on payments, but we have to collect a lot of data on payments, and we collect data that meets the requirements in every jurisdiction. We obviously screen that data against AML lists, OFAC lists, etc. And we take a very, very conservative approach. For example, with recent sanctions against Russia, given the troubles in Ukraine, because it's quite hard to actually isolate the route any payment is going to take. We simply don't make payments to Russia at the moment. That's a policy decision we have as a company, and that's really important for us to make sure that we're very clearly on the right side of where the regulators should be. And that's not because we have to do it. It's not a begrudging thing. It's because it's the right thing to do. So, when you think about more broadly, though, there are certainly some things that the regulators can do to help FinTech. One of the things that we find is, there are standards out there. FATF is a great standard. The reality is it's not universal. What you have is every bank takes their interpretation of the regulation, and that makes it very, very difficult for any FinTech firm to be able to meet all of these hurdles. This is actually great for us because we take that complexity, we internalize it, and we expose its simplicity to our customers. But it would make our lives and everyone's lives a lot easier if there were much more universally applied KYC and AML principles. And the second key area is, when we make a transaction, everybody who touches that transaction incurs some of the risk of that transaction going bad. And so what that means is, not only our banking partners, I think few people realize how many banks any transaction goes to. All of our providers are banked by other banks, and they're all held to account on the same standards. And so what you get is a really, really risk-averse system where everybody wants to wash everything. Everybody wants to know exactly what data is collected, and it becomes very, very expensive to process transactions. And so by separating that out, and by, if regulators could say very, very clearly, this regulated entity here is the one who's responsible for that transaction. We're not going to hold every other bank who's involved in that transaction to the same account. That really takes a lot of the risk out of the system and starts to make that risk reward a better thing, so that we can trade and move money around the world more freely. I think the third thing, and actually the US Treasury sent out a very interesting missive last week, encouraging banks to take a more risk-based approach to FinTech firms. What they said was, you can't say as a policy you're not going to do business with MSBs, money service businesses. You have to take a risk-based approach. You have to look at the what's high risk, what's low risk, and think about your approach accordingly. Because banks could be accused in some sectors of being anti-competitive. The reality is that there's new technology, they feel threatened, and this is a very easy way for them to say, we're not going to touch this and we're going to shut these guys out of the economy. We all need banks. Banks run the systems, and the banks I work with on a day-to-day basis, they're good guys. So I'm not saying they're anti-competitive, but I do think it's an important area that banks do need to think about how can they find ways of dealing with different types of businesses and dealing with innovation and not just saying no. And that's particularly interesting for crypto or virtual currency firms. So I was at a government-sponsored event a couple of weeks ago, and the UK regulator, the FCA, was there. And there are a number of companies who deal with Bitcoin. And we're going to come on to that, so I don't want to get embroiled in a Bitcoin discussion right now, but they can't get bank accounts. And so you've got these companies who are trying new and cool stuff, and they literally can't get bank accounts to be able to run their businesses. And then you wonder, how are we going to get this off the ground? Putting aside all the regulatory concerns about Bitcoin, and there are some, and they're fair, the reality is we're never going to get past those unless these guys can actually be legitimized and find ways and work with the regulatory system and the banks to find ways of working. And the final one I think is a well-known one. We're going through this at the moment. If you want to work in the US, whether you're a European company, US company, a Brazilian company, you have to get regulated in 50 states. You have to report to 50 states. And there are some moves to make this simpler. Some of the states have come together to have consistent approaches, but it's hard. And it really is a barrier to FinTech firms breaking through and showing consumers and businesses the cool things they've got to offer them.
So a couple questions have come in since we chatted, and I'm conscious of the time. So let's see if we can answer these questions quickly. One I think is really interesting: the role of the CFPB in impacting FinTech growth. Any thoughts on that?
I'm not going to claim to be a compliance expert, so I'm going to have to pass on that question, I'm afraid.
John?
And that's broadly because it's a US question, so.
Gotcha. Okay. And this is more of a clarifying question. The slide that you showed with the big bubble that is the billions in fines versus the smaller circle with transaction revenues, it's not a question that banks are not complying, that they're being assessed fines. When they're found to be out of compliance, the fines are based on the size of the institution, not the amount of transaction revenue. I think the question is, why are banks willing to incur the billions of dollars in fines? And I'm not sure that they're willing to. Is that correct?
More and more banks. Yeah, exactly. You're seeing more and more banks who are really pulling out of the international payment space. To name some, HSBC were fined $2 billion in 2012, and they effectively pulled out of large swathes of the space. There's a lot of noise in the news earlier on this year with Bancorp, and when these things happen, they really shake up a bank's internal attitude to risk. And so I think some banks accept it; they're willing to take the risk. Trouble is, when they get burned, the pendulum swings and they get exceedingly risk averse.
So then a final
question.
Yeah. So then a final question is, is one that is interesting, and it really goes to the resources of small firms in FinTech that are trying to get off the ground. Obviously, in your business, compliance is a very important part of what you do because it's pretty core to your product. But in other cases in FinTech, what you see is a lot of these young innovators understand they have to be compliant at some point, but rather than put their money into compliance, they put their money into product development, thinking they'll worry about compliance if they ever get big enough to matter. What's your point of view on that?
I think, sadly, I don't think that works. You know, you can get away with it a little bit, but the reality is so there are two regulators here. There are the regulators, you know, the governments who we work through, and then there are the banks who actually enforce those regulations. The reality is you know, we get audited by various people and various things from government agencies, and they're relatively easy to get through. What's challenging is when a bank comes in who wants to work with us and they're poring over all of our systems, they're poring over it, and you know, those are the ones who are asking the hard questions. And so you can avoid investing in compliance at the outset. The reality is it's going to make it very difficult to get yourself banked. And yeah, it depends on the type of firm. If you're dealing with money, though, you have to invest in the compliance systems up front.
And just to add to that, I think that's a huge thing that a fintech company can offer the marketplace, is to simplify that, is to embed that into the technology. I saw a question a little bit earlier about if we're a technology company first and a financial company second. Well, the reality is that technology is the way that we present our business process. There's a whole load of knowledge in this company. I think someone counted 200 years of financial knowledge. I think that's held in two very wise old men. But so we have this huge knowledge. And what the technology does is it slowly eats that knowledge and turns it into systems and turns it into process, so that we're then able to pass that encoded knowledge to our customers. So we talked about FATFA compliance. That's built into our system. You can't send that money to us without all those fields being completed, so that we can share that information and report. That's how we address it. And it's our job as a fintech company to innovate and provide solutions in this space. It's no good bleating about it, moaning about it. The reality is, you know, we don't want to participate in this world of sending money to the wrong people. So what we want to do is innovate and make it easy for our customers, because it's not going to go away for those guys either. Gotcha.
So in the time we have left, we've got about 10 minutes. There are a couple more questions, but I want to get through virtual currencies, because I know you have, we really think that this is an interesting question. We had a great discussion as we were preparing for our conversation last week. So why don't you set up the conversation? I loved your analogy, Bitcoin and the Bitcoin protocol to the digital music revolution. Give us give us your view of that analog.
Well, just before we get on to that, and it's a kind of fun way of describing it, just so that you're aware, so as a business, the compliance discussions we just had, we cannot operate in a Bitcoin environment. Our regulations and compliance requirements don't permit us to do that. Nor do we believe that sovereign states are going to give up their sovereign currencies and participate in a digital marketplace that looks like this. So, but there's some really interesting points, and this is where the Napster scenario comes in. So we're all old enough, young enough, I don't know which way to put it, to remember Napster. And Napster came along and it did something. It challenged the status quo, and it challenged the status quo of some very big companies. Big publishing houses, record companies that had licensing agreements, global licensing agreements. And what it said was, actually, you know what? Consumers don't want to walk into a shop and pay £15, $20 for a CD. They just want access to all this music. And you know what? People don't really want to own it. They just want to listen to it. And what happened was everyone kind of stood up, and the discussion was about the legality, the discussion about artists aren't getting paid, and it was very passionate, because, you know, music and entertainment and media are something that everybody touches, as is money. And what happened, though, was that it made everyone feel different. It opened the debate, and it changed the landscape forever. And the statistic we're using here, 60% of music in the US is now consumed digitally. Why did that happen? Well, it didn't happen because Napster existed. What Napster did was open the debate. What happened was an enormous company called Apple turned up and said, you know what, actually we think we can go and strike some commercially viable deals and legitimize this marketplace. And they created iTunes, and it allowed them to build a business, and it allowed other entrants to open up into this marketplace. And now what we see is the third generation of that, with the Deezers and the Spotifys that are able to push that music and allow people to listen to it. So I'm a huge advocate of Spotify. I love to consume music, and for me, it makes so much sense. because it's giving me what I want. I want unlimited access all the time to music. I want to have it how I want it. I want to be able to chop and change it. I want to find other music that makes sense. That's how I consume music. The same thing is happening in the digital marketplace for money. And what I'm interested in with cryptocurrencies is not so much whether it's a good investment vehicle, should we be investing in it. I can't give anyone any advice on that. In fact, if I could, once again, I'd probably sell it. But what I'm much more interested in is the technology that underlies it. It's about, for me, it's about the blockchain. It's about this mechanism that allows execution to occur. And this is where it starts to get really fascinating. So there's a few things. Again, I'm not a technical expert, but this is my take on it. So the transaction blockchain has a whole series of information related to the previous blockchain, and there's lots of great videos online that you can go listen to about this, so I'm not going to get into it. But what that's doing is it's starting to create memory and history and if you like, a little business process associated to that movement of money. The other thing is it's distributed, which means that that's happening all over the place and that information is being aggregated together. Then what's interesting to me about this is two things. One, are we starting to see the way that the digital money is moved globally? Is this the kind of technology, and maybe not today, maybe it's not quite there, maybe we haven't seen Apple coming intercede into this marketplace to change it, but is this a way of moving that money digitally? Is this the internet protocol of its era for digital money? This is a fascinating place. Could we create an environment where that money can be moved instantaneously using this technology, legitimized and linked to a business process, so that the sequence of activities that need to occur digitally that release that money, and that money is released instantaneously, so that two parties can create an accord based on a set of criteria that can be tracked digitally, cryptographically through the blockchain and that money release. This is really interesting because we live in a world now where companies are starting to emerge that can do all kinds of interesting technology. Ripple is starting to get momentum. I've just been to Money 2020 in Las Vegas, and there were two things that really struck me about it. The first was how vibrant this marketplace is. The second was how many cryptocurrency organizations existed. It was extraordinary. They were absolutely everywhere. Something is happening in this marketplace. I honestly couldn't tell you what it is, but I know that it's about technology. And I think this wave that we're seeing is the disruption wave. This is the Napster wave. That's our opinion. That's why it's interesting to us. And as a company that's about technology, we're really interested in the blockchain and what it can do for our consumers and what services that we can start to provide. We don't think we're there yet, but we have to look 5-6 years out.
So John, quick question. So you like Spotify, but Taylor Swift really doesn't like Spotify.
That's not a problem for me.
Well, maybe not for you, but not for me either. But apparently, a lot of people who do like Taylor Swift,
my daughters definitely,
are pretty sad because her music is no longer available. And I think it brings up a really interesting, if we're going to kind of carry the analogy through. Yeah. So Spotify and all of those streaming music places are only as good as the selection of the favorite artists that exist. And I think, one of the corollaries to Bitcoin is the blockchain only as good as the vehicles that will use it to move money?
Yeah.
And there's a question that is, is that relevant without Bitcoin? But is the blockchain in and of itself viable without Bitcoin, the currency, or some kind of cryptocurrency that's the container that's moving money across the blockchain?
So I think so this is my perspective. This isn't, I'm not predicting the future. So the blockchain is the fascinating piece for me, but the vehicle that we might move it across might be a cryptocurrency. However, it might, I don't know, got it quite how it's going to work, but it might contain a traditional currency. And so I think what we're seeing is the variants come out. What I love about this marketplace is that I know that innovation is going to drive it, and I know that it's such a fascinating, vibrant place that we're going to see that change. It may be that the combination of the cryptocurrency and the blockchain is the way to go. It may be that we lose the cryptocurrency bit, and actually what happens is that some major currencies or major institutions legitimize a way of sending that money across that technology. It might not even be the blockchain technology, it might be another variant associated to that. And this marketplace is full of stories like this. And I remember I worked at IBM and Todd was at Microsoft. So we've not always been entrepreneurs. We've been the hard school. We've walked the dark halls. I remember when Linux came out.
Oh, man.
That was, for a company like IBM who had basically given up. I actually met the guy called Don B. Schuler who withdrew OS2 in the marketplace. He looked like a haggard man. But for a company that just got out of operating systems, and for a company like Microsoft, which basically made operating systems at the time, no one knew what the hell to do. So the answer is it's not legitimate. It's not safe, and all those kind of things come out exactly the same as we saw with Napster. But what happens is, someone very wise told me this the other day, is that some kind of benevolent dictator emerges and says, hey, actually what we can do is legitimize this and present it out. So this is just another variant. I don't know what the answer is, and we saw a very similar thing with Internet Protocol. They chose IP rather than the other variants because it was free and it was fast and it was quick to use. So there'll be some commercial and some technological benefit associated to it, and the market will decide. That's what's so great about fintech. That's what's so great about what we're doing is the market decides, consumers decide, and innovation will emerge because the marketplace supports it.
No, I think it's a fascinating conversation, and I still think there's a difference between streaming music and sending money around the world. Both enjoyable things, by the way. But I think it certainly is a fascinating topic of conversation. Lots of innovation, lots of people trying to solve the problem, which, to the point of your last slide, is a problem that's been around for a very long time. In the minute we have, kind of wrap up and give us the this. Now I do still see mailboxes. That is, we don't see a lot of payphones, but we still see mailboxes. No. What's in closing comment that you'd like to leave us all with?
On this cryptocurrency piece, it is extraordinary to me that I can send a physical item to another country in a day, and I can't send a digital currency to another country in a day. And if I do, and I send it over the SWIFT net, which is my only opportunity to do so, someone takes something out of my box. That's an extraordinary scenario to accept. That's what's driving this change.
Well, that, as we look at the 1 hour mark, is a very profound way to end what has been a very enjoyable conversation about the state of global payments today. Really enjoyed your perspective, and so did those who joined us today. I could tell by the questions and the fact that people hung in there for 60 minutes. Fascinating conversation. Look forward to doing it again. Thank you very much, John and Todd, and thanks to everyone who gave your time to be with us today. Talk to you soon, and have a great rest of your day. Thank you.
Thanks very much, everyone.
Thank you. Bye-bye.